There are two aspects to this ongoing crisis, and yet people can only see one. I'm going to talk about both in today's video. It's important that we look at what's happening with inflation. People experience that when they go to the gas pump, when they are going to buy their food at the supermarket. But there's something else, and that is with the corporations. When they experience inflation, they run into a very serious debt problem, and that's going on today. This could, in fact, unravel the entire financial system. Not like we saw in 2008, something very different. We'll look at that today, but I wanted to start with one of my favorite charts of all time, and that is this. It's comparing the S&P 500, which of course we're looking at the stock market in general compared with the central bank balance sheets. Michael Gayed, who I interviewed a while back, said, "What do you notice here?" And when we compare the stock market, represented here by the S&P 500, with the central bank balance sheets, in this case, he's just showing the total assets of the Fed, ECB, and the Bank of Japan, or we can look at it a little bit further and include other central banks too. It shows us that we have a divergence between how much money has been pumped into the system and where the markets are at today. This divergence is part of what I call the money mirror method. And I've been talking about this a while. We are at a crossroads right now. I'm not the only one talking about it. I just named it. And that shows us that there is reason for concern. When the markets get ahead of themselves, they run into an inevitable fate where it reverts to the mean. But the other option, the other potential is what would occur if it started to come down somewhat and then we enter into the printing presses 2.0. You see, there's a crisis going on and it's being felt by people, certainly. But at the same time, the corporations, these financial establishments, have their own crisis, unlike what we even saw during 2008. And I want to explain that to you in today's video. It starts with this. US corporate debt defaults surge 176% as the Fed's war on inflation pushes more companies into financial distress. What happens when you have a company that can't pay their bills? Well, then it starts to go back to the lender. And then what about the insurance companies? And what about the, other companies directly involved with those companies for some reason or another? They're a supplier to them or what have you. One by one, the dominoes fall. All right? If you think today what you experience at the gas pump is an issue, understand that diesel has an even bigger issue. So we've got to look at this on multiple levels. Yes, there's a problem with individuals and what they have to pay. But what about when we start to unpeel all of these layers of the onion? Oh, it gets real messy, all right? You got to chop those onions. You got to shed some tears, unfortunately. A debt cycle is painful and losses are inevitable. What is the result, though? What will the central banks do? Well, I'm not afraid to tell you the truth. You're a truth seeker. You're here today. And that means you want to not only know what's going on, but you want to thrive and you want to prosper. And so we'll talk about that. Having that knowledge and being able to stand up and realize that, yes, this stuff is getting difficult, but I want to know what's going on. Let's go. You could see more of that in this article, but just briefly, debt defaults by U.S. companies surged 176%. As many as 69 firms missed payments during the January to August stretch, up from 25 in the same period of 2022. It's all kinds of different companies. Sure, we got the percentages and so on, but understand that this is a phenomenon that is being experienced right across the board. Corporate interest payments are about to rise. Non-financial interest expense paid, and that implied by factoring in Moody's seasoned BAA corporate bond yield to the stock of debt. Yes, I know that's complicated. All you need to understand is that we are going to hit a wave of potential defaults, and it's all related to interest rates. What we experience right now is simply a small part of the entire puzzle. We're never going to know it all. But what we can do is see the pieces of this and start to put them together. And we already have enough to realize that this is a crisis unfolding before our very eyes. The corporations, the banks, these entities were reliant on these super low interest rates. And then they went headfirst into it. They were buying things to get more yield. Even what I've just read recently, a Wall Street Journal article, talked about this trillion-dollar industry of brokered deposits. Brokered deposits. You've got all this money coming in from these companies trying to do anything that they can, paying more to get the deposits into their companies so that they can loan out more, so that they can use that and put that at the Federal Reserve. It's all arbitrage. Oh, I get your deposits. You're going to get nothing for that. And then I want to take that money and I want to invest it somewhere. Maybe it's going to be held overnight at the Federal Reserve so I can make a little bit of cash. Maybe I'll loan it to a business. Maybe I'll loan that to an individual. But that's what these financial establishments are doing. However, a few years ago, interest rates were so low. They had to take more and more risk. They had to buy mortgage-backed securities. They were doing everything. And that is where we have our risk today, because now the returns on a lot of the products have risen dramatically and they're stuck holding on to all this stuff that doesn't have any value anymore, or much less. And so they are in a bad position, and that is starting to make its way through. At the same time, you've got companies feeling the burden for one reason or another. So I hope this is very clear. BMO, TD, and CIBC, Canadian banks, have negative amortization on a fifth of their mortgages. Rates need to come down on principal, will keep rising in a down market. Big problem, okay? We're talking about billions and billions of dollars at stake here. Negative amortization. Just imagine that. People are underwater at this time. And what's the solution? Don't worry. We'll kick the can down the road. We're going to print more money. That's never, of course, the real solution. But they're going to do that and cause more what? Inflation. Yes, I know when you go to the grocery store, there's more inflation. When you go to the pump, there's more inflation. When you get any service, anything, it's more expensive. So let's look at a few things. You could see retirement homes in Europe. This is just one, but you can take away Luxembourg and Switzerland. These are, outliers potentially. But look, Netherlands, €200 a night is the average daily price of a retirement home. Okay? €200 a night. Do you know a lot of people that could afford that? No. But what am I trying to highlight there? In the United States, healthcare costs. I mean, just anything, just name anything. And the prices have gone to levels people can't afford. And it's getting worse. So just imagine if we encounter a crisis, they are going to meet that crisis with heavy inflation. So watch out. The world is struggling to make enough diesel. So you see, you have a problem with gasoline. Oh yeah, it's expensive. And yet, diesel, which is used for the transport, that is now encountering a problem. Supply and demand. Crude production cuts have been detrimental to diesel supply. Refineries have sought to satisfy demand surge for other fuels. And so just keep an eye on this, of course, because it's going to affect the cost of transport. That means you got to pay more for everything. Okay, watch out. Gasoline prices soar to US seasonal record. I know people are feeling this, trust me. We have this. McDonald's franchise group says new California fast food bill will cause devastating financial blow. What they want is to put a wage floor of $20 for people working at McDonald's. Now, I understand that would be good for those people working at McDonald's, but I'm going to have to be honest with you. Flippy the robot is going to get a lot more time in these businesses. There's no question about it. You implement $20 on that, you're going to have to pay them $20, $25. Look, they're going to have to get raises as time goes on, potentially. $20, $25 for a fast food worker. These companies can't afford that, or they won't afford it. It doesn't matter. Like, however you want to look at that, they're just not going to do it. More robots are coming. So watch out. Prepare accordingly. American manufacturing is coming back, and so are the strikes. The reason I mentioned this is just quite frankly that what we're seeing with employment right now is a precarious circumstance for a lot of people. We're going to see the more strikes happen, and they are all around. More strikes happen, wages go up, and what do the companies do? Do they take away from their profits? Of course not. They raise their prices. And so as we see these price rise, constantly coming through, we're going to see inflation going up. What is the solution to that? What will central bankers do? I think it is pretty clear that they will need to implement something to make everybody happy. Oh, by the way, we've got this thing. It's called a central bank digital currency, and we can make sure we're taking care of you. And that might have some strings attached. Oh, yes, that's right. Those strings, who knows? Who knows? There might be, by the way, in connection with this, the Universal Basic Income, UBI, and they might have a social credit score. They can certainly be able to turn on or off your currency at any given moment. They've said this before multiple times. We want the ability to basically say who can and cannot use this currency. So that's their idea. So we have the crisis, and all we need is now a solution. And so I worry about this, and I wonder how people are going to get along with all of it, because for the average person, they're not prepared. They're not ready for this. All right? So be mindful of it. Let me talk to you for a second about what you can do. Don't just sit there. Don't just take it. You got to be aware, okay? The first thing is to get out of debt. How do you get out of debt? I think there are obviously a few things that you could think about. I've outlined that completely on my Discord, which I'm showing you here, as well as on Compass. How do you get on Compass? At the time of this recording, it's only for the people on Discord and, of course, the mentorship group. Go down to the link in the description. Get on the Discord. It's totally free, and you can get that. How to get out of debt. There's videos in there for you. Lots of stuff to cover. I think it's pretty obvious, but the bad debt, get out of the credit card debt, get all those buy now, pay later things. It's not worth it, okay? Shortages and price increases are more common. We need to be prepared. It's going to get worse. Look at what's going on with rice. The export ban, I believe, is going to be expanded from India. And so that's just one thing. That's just one aspect. It's becoming more common. I'm seeing it all the time, all right? And don't trust a financial establishment to make you money. They're in the business of making money. Okay, so who are they looking after? They're looking after themselves. So that's why you need to look after yourselves and realize, yeah, you can put your money with an establishment. That's fine. But just know who they're serving. Okay, keep that in mind. These are just a few things. I try to highlight this at the end of every episode. If you appreciate it, hit that thumbs up button. Okay, that really does support the channel. So if you click that, you're supporting me. Okay, I want to know what your thoughts are about this, that there's a crisis right now as we speak, not just with individuals. We talk about that all the time. But of course, when we look at the debt circumstances in relation to the corporations, what did you think of that and what I talked about? I want to know what you think. This is Discord. If you want, you can get in over here joining 1,300 plus people. Anybody that messages me, they will get a reply on Discord. Link in the description. Comment of the day. Valerie, thank you very much for this. Great video today. David, I think about some of the same issues that you brought up, especially all of those empty downtown skyscrapers. Most of them are emptying out. No revenue coming in. It looks like it's going to be a big bust. And that's part of the circumstance I've talked about today. These companies, if they start going bankrupt, if they can't pay their bills, they empty out of these commercial buildings, and then one thing after another after another. If the banks are losing, they start laying people off. If the companies around the banks don't have the customers like they did before, they start laying people off. It is a chain reaction. Watch it very carefully. There's so much that I can and would have loved to cover, but here we are. I hope that you'll tune in tomorrow so we can get into even more information. All right, I'll see you on the next one. Take care.